Hey everybody, welcome to session 2 of point and figure charting to maximize your process. Thanks everybody for coming. This is going to be another chock full night of, or another night of chock full stuff. It doesn't sound like we're going to do a lot, but we really will. We're going to cover a couple of updates that I want to go through with you here, and then I'm going to do a very quick review of point and figure charting so that we don't forget the fundamentals here. And then we're going to go deep into Bob Evans's count guide, and we're going to be, in doing that, we integrate the vertical line chart and the point and figure chart, and we'll talk about some additional point and figure charting concepts. But questions about where do you create the line for the count, and when do you make the count, and all of that. That's all addressed in Evans's count guide. So we're going to go through that tonight in some detail. Okay. Now, in terms of updates, I put up 5 new videos to the members area earlier this week to try to address some of the questions that arose in session 1 and then subsequent after session 1 as well. So the 5 videos include an introduction and overview about what the other 4 videos are about, just to give you a little orientation. Then we talk about, people seem to get confused about this. How come point and figure charts aren't a daily chart? You're using a daily chart, but you're not using the daily data. And what's that all about? And so on and so forth. So I did a video explaining the difference between using daily data versus intraday data on a 1-point figure chart, a 1-by-1 figure chart. And I think it's pretty clear that you really do want to use intraday data. And the main reason for that is because it picks up the accumulation and distribution that occurs during the course of the day when the markets are open. The daily chart is a useful chart for sure. It tells us how the day traded, but it doesn't really tell us what went on or the extent to which what went on during the day. But the intraday data does tell us that, and when we use intraday data on a point and figure chart, it picks that material and information up. So that's important to understand. Okay. I also did a video on how to construct a point and figure chart figure by figure. I guess I got people confused a little bit by using a 60-minute bar chart and then trying to show you how that got constructed, how the point and figure chart got constructed off of that, which is then used, then we were using it for on a daily chart. So people got very confused about that, and I apologize for that. But that is the way it works. And so instead of using a bar chart, I took a 60-minute bar chart of a recent stock, a month's worth of trading in a recent stock, and I took all the swings, and in fact, this is how you would do it. You would take the swings and the price swings, record them, put them on a chart, and then we constructed the point and figure chart from that data, not the actual bar chart itself, although the data came from the bar chart. So that should address any questions about how to construct a point and figure chart. It's simple once you get it, but I understand that it takes a little bit to get it. So hopefully that is going to help you understand it better than you did if you had any questions or misunderstandings about it. I also put in a video on the Wyckoff terms that we were using. This is based in Wyckoff, in the Wyckoff method, and it's really hard not to be using the terms, and it's hard to explain every one of the terms as we go along. Some folks here aren't all that facile with the Wyckoff method. Hopefully by seeing some of this material, you will become interested in it and you will get facile with it, because I think it's the best way to trade. Otherwise, I wouldn't be doing it. And I tried all kinds of stuff for several years trying to make trading work until I figured out Wyckoff. Until I figured out Wyckoff was not an indicator, but a guy who really is the father of technical analysis. He and maybe Schaubacher were writing about the same time, and Charles Dow were all writing about the same time. Gann came a little bit later, and so did Elliott came a little bit later. But all those guys were talking about technical analysis, and Wyckoff was one of the very earliest, and I think the best, absolute hands down the best. So things like sign of weakness and springs and upthrusts and tests and that sort of thing, I define those and talk about those in that video. Then the last video is on intraday point and figure charting. A couple of people asked for that. We'll show you a little bit more about intraday point and figure charting on a currency at the end of this night's session. But I wanted to cover a little bit of work in the S&Ps for you. So we looked at a week's worth of trading in the S&Ps last week, or the week before last. I forget which week I looked at. And even if you don't trade intraday, you're a swing trader, and especially if you don't understand some of the Wyckoff stuff, or you think you need to brush up on it a little bit, watch that video, because I did it after I did the Wyckoff terms video, and so some of that information just bled right over into the S&P point and figure video. So I talk a lot about the Wyckoff terms there, using the point and figure chart. So that should be helpful for folks as well. We posted up the videos from session 1 or something new. These are new. These are in addition to session 1. Session 1 is also there in the members area, the video for that. But these are 5 videos that run, I don't know, about 10 minutes to maybe 30 minutes a piece. They vary in size, in time, but they're additional information for you. So we also posted up the count guide, Bob Evans's count guide, as a PDF. So you'll have that, which is it's a very, as you'll see, it's incredibly useful. And then we've got the slides for both session 1 and session 2 there as well in PDF format. Okay, all right. So you're quite welcome, everybody. That's fine. I wanted, boy, if you don't understand this and I'm teaching it, I just feel like I've really fallen short, and that's just not going to happen. So if when you don't understand something, you got to let me know, and I will jump through hoops if I need to try to teach you what I know about it and make it clear, because that's really important. You guys need to understand how this stuff works. It's very powerful stuff, but you need to understand how it works. All right, so let's move on from here, and we'll take a break. I would imagine we're going to go, we could probably easily go 3 hours on tonight as well, but I'm going to try to keep it to between 2 and 2.5. So we'll take a quick break around, say, 10 after 6 my time. In an hour from now, we'll take a 5-minute break. So maybe somebody can watch the clock and let me know. Okay, so I want to just do a quick review of the fundamental ideas of point and figure charting. You need to use them in connection with the vertical line chart, and we're going to do a lot of that tonight. The first session was really to get the fundamentals down about how counts work and what we can see in the charts and so on and so forth. And tonight we're really going to do kind of practical applications of it. So just the basic ideas of the point and figure chart. It's really, really good with highlighting congestion and support and resistance. We see the sideways movements and the pullbacks clearly. We see where they begin and we see where they end on the point and figure chart. I think it's a much cleaner representation of that, especially support and resistance, than the vertical line chart. You can certainly see it on that as well. But point and figure chart is, it's a little bit of a blunt instrument, but that bluntness has clarity to it. And I think it brings out real clarity in support and resistance in these horizontal formations, these congestion areas. And as you can't really help but see the support and resistance levels. To me, the point and figure chart gives the best data or information on support and resistance. So that's what they do exceptionally well. They also highlight the accumulation and distribution. Accumulation precedes the market rallies, and the distribution, of course, precedes the reactions. So, and we're going to see more of that, more about that tonight. And by the count that we create, we can get an indication of the potential of the coming rally or reaction. Don't get so wedded to these counts, by the way, so that you say they have to go to that. I'm going to show you tonight where they don't, in fact, go all the way to that. You've always got to be on the alert that a count may not go to its full extent. That being said, the majority of the time, you're going to see the counts are very good. And we started talking about counts in the first session, and now we're going to begin to develop more clarity, and we're going to try to refine a little bit on how to make the counts, and when to make them, and where to make them. All of that sort of detail is coming up. Also, we didn't really talk about this last time because I didn't want to introduce new Wyckoff ideas, but one of the ideas that Wyckoff had, he basically said that there are three underlying all of the technical analysis and all the stuff that we can see in the vertical line charts and the point and figure charts. There are three underlying principles, if you will. He actually called them laws. There's the law of supply and demand. Markets do not move on anything else but supply and demand, selling and buying. Yeah, news is going to affect the market. It's going to cause people to sell or it's going to cause people to buy. But in the end, it's always the direct selling and the direct buying that moves the market, even if it's goosed by news or influenced by news. And we can see that in the price bars and the volume. Sometimes it's not that clear, but much of the time, we can see that supply and demand. He also talked about effort and result. It takes effort in the terms of volume to drive the market and create the result of price action. So we are always pairing volume and price action together, and I'm going to show you that quite a bit tonight. And then finally, he talked about cause and effect, that their markets rarely turn on a dime. Some of the studies that I've read say about 10, maybe 15% of the time, you'll get that V-spike reversal. But even in those V-spike reversals, you'll see some preliminary demand come in or some preliminary supply come in, and other ways to see that there was indeed accumulation or distribution in that movement. But 85 to 90% of the time, the market goes sideways for a period of time and builds what's known as a cause. As a thumbnail way, we say that's the count is the cause. We can create a count that represents either the accumulation or the distribution that's occurred in the market, and that will have an effect. That's our projection. So that's an important idea here in point and figure charting, or an important concept, because we don't just highlight the accumulation and distribution, we count it. And we count it because it gives us a good indication of what the coming rally or the coming reaction is going to be. So we look for that cause before we enter into the market trading in this way. Would I call it perceived value? No, not really. Just the cause. That's all. Opposed to the minor forces from news driving the market. Would I call it perceived value opposed to the news? No, I just call it accumulation and distribution. The so-called smart money will use the news to either further accumulate or further distribute or to mark up. I mean, they use the news all the time. So it's not really about value. It's just about supply and demand, cause and effect, that kind of stuff. Okay, and then the point and figure chart, probably the more, I guess we would say more minor, but still very useful aspects are that it helps us identify trends. We can put trend channels on and see pretty clearly a point and figure chart trending. We can certainly see the markups just as well as we can see the horizontal formations. And then we can estimate the halfway retracements and understand a little bit about strength and weakness in the market. Okay? So that's the basic ideas behind point and figure charting. Any questions on that? Everybody understands that. I mean, that's kind of the theory behind it, right? And I'm a big believer that you need to understand theory in order to be able to operate practically. So this is just a basic conceptualization of the Wyckoff market cycle. We have accumulation occurring in a horizontal formation, right? That then leads to a markup. And here's our markup. Sometimes we get a little more accumulation in here or in here, and we can often take a count. We're going to see this tonight called the stepping stone count that confirms the original count, or maybe confirms, we might have a couple of counts here. We might have one count here, and we might have a larger count here. And at this point, we might get a confirmation. We might have exhausted the initial count, right? This count 1 maybe goes to here. And then we get another count in here that's pretty close to this count 2 down here. We would call that a stepping stone count, and that count takes us up to about the same level as the larger count down below. Okay, so it's not just that markup occurs and we go straight up. We can certainly have, as I'm sure you know, consolidation moves in here, trading ranges in here after the markup. But these are also of value to us in using this method, and I'll show you about that tonight. All right, same thing. Once we get to the top here, and the trend is no longer going up, but we typically see a sideways formation, a horizontal formation, and then a sign of weakness occurs after that, and we start, this is distribution in here, and the markdown. Okay, so accumulation, markup, distribution, markdown. Those are the 4 basic phases to the market cycle. We see accumulation occur. That leads to a markup. Eventually that exhausts. The cause down here from our point and figure charting exhausts, and the market is no longer being marked up. It goes sideways. Distribution sets in, and then we get marked down. Until some point where that count exhausts, we go into an accumulation phase, or it could be a further distribution phase. But we go into these large horizontal formations prior to marking up and marking down. Sometime you might have heard about. Whoops, sorry, pressing the wrong buttons here. You might have heard about a market coils, right? And the coiling leads to a breakout. Well, that comes from Wyckoff. This coil, so many people, technical analysis writers, just sort of copped Wyckoff's material, rephrased it, and they say, well, the market coils, or it goes into a trading range, and that, builds up energy, and then the energy releases, and all this other stuff. Well, we call it accumulation, markup, distribution, markdown. Make it a little bit simpler to understand, and a little bit more straightforward. Okay? All right, some questions here. Thanks for creating the extra videos, no problem. If you only had one choice, would you use point and figure chart or the wave chart? Oh, that's hard to answer. Unfortunately, I don't have to make the choice, because I use both. I think they're both important. Yeah, some people call it the squeeze, right? Bollinger Bands, right? It squeezes down. The percent B squeezes way down, and then we get the markup. Well, it's just a measure of volatility, and volatility gets small, it diminishes, and as the trading range matures, typically we see the volatility, crimp down even more. It doesn't always have to happen that way, but that's a typical way that it does. And when that, when it gets squozen like that, we expect a breakout to occur. So yeah, exactly right. Bollinger, by the way, I had a conversation with him one time. I don't really know him. I just met him once, and he talked about how a lot of his stuff was influenced by Wyckoff as well. Is it after it coils? Is marking up pretty strong? Yeah, typically, because the market needs to move, and we'll see some examples as we go on. You'll see that here as we go along. So, okay, let's so keep that basic model of the four phases, the four cycles there: accumulation, markup, distribution, markdown. Keep that in the back of your mind all the time. Kind of gives you a sense of what might be happening next. Okay, so Wyckoff used point and figure charts extensively, and he wrote about them in both courses that he did. He did a probably one that most of you are familiar with, known as the course for intermediate and larger moves in the stock market. But he also did a course in tape reading for the smaller moves. And in both, he used point and figure charts. Now, Bob Evans, who's this guy? Well, he came along in the he knew Wyckoff. And Wyckoff died somewhere, I think it was 1934 or 33, something like that. Evans was very young at the time, and knew Wyckoff and had a lot of conversations with him. And then Wyckoff died, and Evans stayed with. Wyckoff set up an educational. It's not nonprofit. I was about to say that, but I don't think it is. He set up an educational organization to teach this method to the public, and Bob Evans became part of that. And from about the 1940s to the mid-60s, maybe all the way through the 60s into the early 70s, he would make, and you can see him here doing this, he would make tape recordings. He was the educational director. He might have been the full director at one point of the Stock Market Institute. I don't know, or Wyckoff Associates as it would have been called in his day. I don't know that kind of history, but he made one of the things that he did two things that he's known. Well, he's done a bunch of things that he's known for. He was he was a great trader of the stocks of his day, and he would not be scanning for first of all, they didn't have the computer capacity to ability to do that, but he would be happy just trading a dozen stocks, and he would pick the most liquid ones, and he would trade those, and he was known as a heck of a good trader. He also created a lot of the Wyckoff stories, like jumping across the creek, falling through the ice, the Oops story, the Shell Divers tragedy, the frog. He had a bunch of them. He was kind of a campy, corny kind of a guy, and he talked a lot about Boy Scouts and that kind of stuff. But it was all designed to help traders understand. These stories were all designed to help traders understand the charts a little bit better. So part of his stories and part of his adaptations were the spring and the upthrust that we're going to talk about tonight. He created those concepts based on some Wyckoff principles, but basically he came up with those. He also created weekly tape sessions from the late 40s into the 60s, and I've listened to an awful lot of those tapes over the years, and they're all really good. He was pretty marvelous about doing that stuff. He also updated and amplified the Wyckoff course, the main course, for the intermediate and larger moves. And if you were to buy the full course from the Stock Market Institute, you would the Unit 3. Unit 1 is now an introduction. Unit 2 is the original course as Wyckoff had written it, with very, very little modification to it. It's been updated a few times, but the updates are very minor compared to the original. Unit 3 is Bob Evans's work, and he talked a lot about accumulation and distribution. He talked about figure counts and the figure charts and the count guide and all of springs and upthrusts and a variety of other things as well. So that became known as Unit 3. Unit 4, I forget what Unit 4 is now, but Unit 5 is practice trading. Unit 5 is the test, and Unit 4 is practice trading. That's what it is. It's been a while since I've looked at those last units. But anyway, he created Unit 3. And he also created the count guide, and we're going to talk about that tonight. And we'll use this. And the count guide really is excellent. It clarifies how to use the point and figure chart in combination with the vertical line chart. And really, this session tonight is all about the count guide. We're going to spend the majority of our time tonight on it. And he splits the count guide, Evans splits the count guide up into two sections. And they're basically mirror images of one another. Up counts for rallies and down counts for reactions. So we're going to start in with the up counts. Okay. Let's see, I'm not sure if it's spelling it correctly, but would you show an example of the Shell Divers tragedy? I don't know that we're going to do that tonight. I don't have that in here, and I'd have to create something for it. And I don't know that we're going to do that. We might. If we do, I'll highlight it. But all right, so let's get to the count guide. And I'm going to go do this pretty much section by section. I'll jump around a little bit. You've got the full count guide in the I've printed it in here in the slides, though it's really fine print. And so I put it in as a PDF in the members area as well. So we're going to go through the count guide section by section, and I'll illustrate how to apply it to cocoa, the cocoa commodities futures. I picked that because I want to show you that this stuff works in anything, any market. So we're going to, and then later on, we're going to track a stock showing how the count guide factors into our analysis in some of the movements that one old line stock, United Technologies, how that all unfolded. And then from there, we're going to look at intraday trading on the British pound and show you how the count guide applies in that instance as well. Okay, so you'll get a good amount of different markets here, showing you how all, and different time frames, showing you how all this stuff works. Okay, so the count guide, an up count. After having identified a sign of strength on the vertical line chart, locate the last point at which support was met on a reaction. This is known as the last point of support. Locate this point on your figure chart and count from left to right. So you see, Evans tells you exactly where and when to make the count. And then he always says, and I try to emphasize this in session 1, take the most conservative count first and move further to the left as the move progresses, and as the move allows you to do that. So first thing we need to do is identify a sign of strength on the vertical line chart. Then we're going to be looking for a reaction after that sign of strength, and then see support come in on that reaction. That's what we call the last point of support. That's where we take our count from. Okay? And as I say, we're going to go and use Coco here from a couple of years ago, and we're just going to start with this. So does this chart look bullish or bearish to you? I got a bunch of bearishes, a couple of bullish, ranging, bearish, yeah, bullish. A couple of folks say bullish. Most people are saying bearish. Well, it's actually bullish. It's actually bullish. And we're going to find out why. Okay? In fact, it's decidedly bullish. All right. So let's see. We always want to apply structure to the market. At least I do. I don't know how anybody does it without adding structure. And once we add a couple of, I've added 2 lines here. Well, 3. But I've added 2 lines, and I think things become immediately clear, or should become quite a bit clearer. Let's go back a second. This is the chart without any lines. And when we add the lines here and give it a little bit of structure, suddenly we can see things. The first thing that we can see is that we get oversold down here at A, right? And we rally up and we break the trend channel. Okay? We break that trend channel on pretty nice, it's hard maybe to see this, but these price bars have the nice wide spreads, closing firm. Most of them are closing on their highs or near their highs. We get a few, really we're going up and up and up. I don't see any down bars in here. Maybe there's one little down bar in the middle of it all. But we have good widespread bars, and look at the volume that comes in here. We get volume expanding as the market is going up. And then we break the trend line. We also have, if we were to think about this in terms of the extent of the rally, it's larger, right, than the rally before here. I don't know, I suppose you can do it a couple of different ways, but I'm looking at the rallies that occurred here before, and this one is decisively larger. Has to be to break the trend channel, right, because your rally is going to be limited in size by the size of the trend channel. the width of the trend channel, and it breaks that. So this is a sign of strength. Okay, it's a sign of strength. Market moves up, shows you clearly that the downtrend is over. And it moves up on strong volume, good spread. So just, looking at this, all the signs of strength occur in here. We get oversold in the trend channel. Notice what happens as we try to dip down here and here and here. Volume dries up as we try to. So no supply down here. No supply. Okay. And then we see good upflow. D over S is demand over supply. Demand is overcoming supply here. There's strong upflow. There's strong ease of movement going up. And it's propelled. Remember we talked about those three laws? Cause and effects, demand and supply, and effort versus result. There's really good effort being applied here, and there's really good result occurring because of it. Okay? As the fuel pedal is pushed down to the floor, price is responding. And that's a positive sign. It shows good strength. We break the trend channel here at B. Okay? And now look at what happens. We get a reaction down. And just in general, look at the volume here and compare that to the rally up. Reaction down is got less volume than the rally up. Okay? So we have a sign of strength, and we see this reaction occurring. And the reaction doesn't stop right down in here. We might have thought it did at first, and we might have started to trade that, but we would know that there was something amiss as the market was coming back down here. So we either have a stop that is down below somewhere, or we would scratch out of the trade at that point. But what we notice is that there's good demand also coming on this rally, adding to that sign of strength that we have from back here. I mean, this is all a sign of strength here. This, clearly, and this. Remember I said before that we want to try, I don't know if I said this to you guys or not, we want to try to combine multiple things together here when we're talking about a Wyckoff story, or when we're trying to piece together what's going on in the market. And so we're looking for evidence here of demand. We're looking for evidence of buying. And really what we're looking for is evidence that buyers are in control of the market. Okay? And it doesn't happen in a flash. It takes time. It's a process. So we can certainly say that buyers are stepping up to the plate here, and that sellers are not very strong, although they do take the market down. Maybe we would have liked to have seen them hold at a higher level in here, but that doesn't happen. Demand comes back in, but then suddenly supply is pushing the market down as well. Although look at what happens. As the market is being pushed down and we're seeing supply enter the market, we note that the volume is diminishing as we come down. Here we see volume increasing as we go up. Here it's diminishing as we go down. So this is saying that selling is losing its strength in here. And then we rally up above. We have a support point here. Erase this. We have a support level here. We come down now. If supply were still in control, we would see a move back down, a resumption maybe of the downtrend. But that doesn't happen. Just the opposite happens. We not only go sideways in here for a little bit, but we start to rally up above this support level, showing that, and we do so on good volume. In other words, demand, this D here represents demand. These Ds here and here represent demand. It's overcoming the selling, okay? And then we come, you may not be able to see this on your, hopefully you can see it on your screen. It's certainly on your chart. We get a classic test right here on the last bar of this chart. And look at the volume, how low it is. Just a very, very low volume. So this is our sign of strength, and this is our reaction back after the sign of strength, that we see the last point of support begin to occur in here, where the supply is no longer driving the market down, but the market is now supported. And it's just a technical term. It's called the last point of support. Okay, so in such cases, sometimes I would draw a new trend channel from A to B that shows me that what shows me that is wrong. Well, nothing's wrong with that. You can draw a trend channel in here from A to B if you want, and it gets overbought up in here and then doesn't stop after it's overbought, and you've got to change the direction of the trend channel. That should tell you that that the demand is strong here. Okay, that this slug of demand coming in has got some strength behind it. Linda says, in a downtrend, do you draw the upper trend channel first, then duplicate it together the bottom? Yeah, we would draw it off of this point and this point. We might draw one from here to here first, which would pick this up. Okay, but then it gets broken over here, so you would adjust it as you go along. So anyway, the overall trend channel comes in here and here, and then you would take a parallel and put it on here. That's right. Would you consider the A point to the hard right edge accumulation? Well, we're going to talk about that, Dan, in a minute. So hang on to that question. All right? Hang on to that question. You would draw a downtrend channel from A to B? Sharif? I don't see that. I'm sorry. You can't draw a downtrend channel from A to B. Oh, widening the downtrend channel. Oh, do this. Well, this is pretty, no, you wouldn't do that, because this is well contained in here. The market's behaving properly. And you've got to piece more than just trend channels together. You might do that. Okay, so you do this and you readjust your trend channels. Just going to make this more oversold. And now you see what's going on here. It's not going all the way down. Why is it not going all the way down? Well, supply, demand. Supply is not pushing it down. Maybe demand must be coming in. And that should cause you to go back and reanalyze what you drew here. Okay? You have to be able to see these things in the way that they make sense in terms of structure of the market. The most important thing to understand about a market is structure. And Wyckoff called it trend, but I would add a little bit to that and say it's the structure of the market. And your structure has got to be correct, otherwise you're going to be getting wrong moves quite a bit. Okay, all right, another question here. A few years ago you told us that you ended up with a lot of lines on your chart. Have you become, or are you trying to be as Spartan as possible? No, not really. But I want to be able to step back and see what the important lines are. So I do that quite a bit. Okay, so let me move on here. Trying to be aware of time. We've got about 65 slides to get through, and we're only on number 10 here, and I can already see that we're 45 minutes into this. So I want to be able to cover the material without going for hours and hours, because it shouldn't take that. So, here's point A and point B from the prior chart. We can certainly see the markup here. You can see that this is larger than the prior up move. That has to tell you that demand is coming into the market. Okay. So now I just want to orient you. The box size here is 25 points. This is just like a 1x1 point and figure chart, but because the way cocoa is represented this is trading around 20 right here, about 2300. So 1 point would be just crazy. It would be way too small of a figure chart to use. So we use 25 points, okay? And then a reversal is 25 points. So it's a one box reversal, if you will. So again, an up move, which is represented by X's, and down moves represented by O's, only occur when 25 points, when price moves at least 25 points. But you understand that by this point, okay? Hopefully. Okay, so we get the rally to B. It's larger than earlier. So we see good demand coming in here. Demand over supply, as we said before. And then we come down and we see the last point of support. Now, the market's holding a higher low here compared to A. Let me erase so we can see this clearer. The market's holding a higher low here compared to A. Okay? And as long as this low doesn't get violated, it's a legitimate last point of support because we have a sign of strength. Remember, Evans's count says after a sign of strength, we look for a last point of support at the end of a reaction after the sign of strength. So you have to be able to identify the signs of strength on charts. And what I would recommend that you do is just go back through a bunch of historical charts and look for signs of strength when a market has been coming down and then stops coming down and turns around and then starts going up. What was it that made that sign of strength occur? Go through your charts and do that kind of work. It's necessary so that you can see that yourself. Okay, now I want to point something out. We do have a swift down move here, okay? But it holds after two figures down here. And then we start to see the market begin to rally and we see the supports starting to lift. So we're going to look more carefully at the vertical chart, line chart for this area. But we want to do that too. We see this swift move down. We have to notice that. That's possible supply, that if this market starts to roll over, then we're likely to at least come back down and test A or go through it. And so then we're wrong in our analysis of the sign of strength up here. So we want to make sure that we're looking at everything. We want to have a flexible attitude towards things before we come to a conclusion. It's not going to be when you say go through this chart, is a point and figure chart or a bar chart? Both. I'd do both. It's not going to be a simple thing. You have to really look carefully. Okay, so now I want to go through, just orient you. Here's A. I've got a daily chart and I've blown it up now. And B. Okay, and then what we were calling the last point of support over here. And I'll go back now to the point and figure chart. Here's A, obviously, here's B, and here's the last point of support. Sorry, I didn't erase that other stuff before. Going back and forth through these different things here. Okay, so let's go through this. Again, now I said before, you could see the widespread up bars and the movement up here. You got good volume coming in on the demand here. We also have good volume coming in on the demand here. As the market comes down, look at what happens to volume. It diminishes down here. Okay, we kind of went through this before. We push back up over the top. Demand comes in, buying comes in to push it back over the top. They come back down here and test it again, and the volume recedes. We rally up a little bit, and then we get this little test bar in here. Look at the very, very small amount of volume. This market is what's called being on the springboard, ready to move up. You can see that it's kind of narrowed down here to Very small little, Wyckoff used to call these an apex. And it's ready to move at this point. Okay. So, as Evan said, we seek out the last point of support. We found it on the vertical line chart, and then we can go and make our count from there. And we go backwards. We go from right to left. Okay. And we can see here, I'm not going to count them for you, but on the 220 line, or the 2200 line, we have 25 figures. I'm sorry, 30 figures. 30 figures along this line. So 30 times 25 points equals 750, okay? And we would add 750 to the low at A over here. So 750 plus the low is 2125. That equals 2875. And that's what our projection is, 2875. The cause here, we're looking for a good solid move up to this point. Okay, that's how we make the count. All right. It should be pretty straightforward. Any questions about that? Okay, go back to the count guide. When we move to the left making our count, go back to our vertical line chart if that count area is large, and it should be. You want to take worthwhile counts. And divide the area of accumulation into phases, adding one complete phase at a time. Never add only part of a phase to your count. Volume usually shows where the phase begins and ends. Okay? So as we're making the count, we go back to the vertical line chart, the standard bar and volume chart, and we look to divide the accumulation into phases. And we add one phase at a time, and we do complete phases, not partial, and I'll show you what that means. In volume, we're going to pay real good attention to that. This is something most people don't understand about volume, but we're going to talk about that. Volume is going to show you where the phases begin and end. Okay? So let's take a look. So let's go to our point and figure chart here for a second. I think it's somewhat easier to start it this way, but we can see that we've got along the 2200 line here, we've got this area. Okay, now going back to the vertical line chart, we're starting where that arrow is over here, that green arrow right in here, on the 2200 line, right there. And if we were doing this on the point and figure chart, it would go all the way back over to here. Okay. And so our counts, our phases get broken down. I mean, this would be obvious, right? If this is phase one right in here. This is the last bit of accumulation that took place. It may be the only bit that creates a markup. But we can go over here. We can see that volume is higher here. It's a combination of both price and volume. Here, price dips down a bit. There's not really volume there. 4 and then 5 is in here. And we could even go back further if things warranted on the point and figure chart. But we've got a pretty healthy count, and that's pretty good for now. So now I've transposed these areas. Here's the 220 line again. Here's phase 1 and phase 2 and phase 3 and phase 4 and 5. I just combined them together because they were so close. Okay, so although there's 30 figures on this line for a count of 2875, what we do in reality is we recognize that In phase 1, there are 7 figures, 1, 2, 3, 4, 5, 6, 7 here. And that gives us a count. 25 times 7 is 175. Added to the low of A of 2125, we add 175 to 2125 and we get a target of 2300. Phase 2 has another 14 figures. That gives us we do the same kind of math. We count the figures, multiply it by 25, and that gives us the move up to 650, which is about here. Okay. Now notice we're already above. Here's 330. We've already gone through phase 1, and we haven't even started the move yet. Right? Well, we don't know that for sure, but we certainly know that there's more demand than there is supply in here. Okay? So we have at least a good shot of getting into this area here, into the 650 level. And then if things go well, we would continue to add our counts, our phases on up to the count. Okay, that should be pretty straightforward. Any questions about that? We want to be conservative. I tried to emphasize that in session 1. And the way to do that is to break your figures, your counts up into phases. And the way to break them up into phases is pretty straightforward. You're just really looking for these dips with the volume coming in. That's basically what you're looking for. And then you want to correlate that to the point and figure chart. And that's pretty straightforward to do. You can see that it's not hard to do that. And then you would be able to go right to this for phase 2, this, so we would, phase 3 is an additional 4 figures, so that's 1, 2, 3, and 4, and that's times 4 times 25 is 100, and we would add that to whatever we've gotten before. So that should be pretty straightforward. Okay, yeah. So the number 1 target was the first phase was already hit. How can you tell the difference between smart money accumulation and trading range consolidation? You don't worry about that. Don't even think about that. Just think about the count guide, and after a sign of strength, when we have a reaction and selling dries up, that you can get a good count, that's where you want to think about taking a trade. Okay? All right, now, as the move progresses, says Bob Evans, you will often see a lateral move forming at a higher level. We call these stepping stone confirming counts of the original count. And we talked about this briefly in session 1. But I want to go into some depth in it here because it's a key section. This is a key section of the count guide. And as you're going to see, it's going to be very helpful in trade management, holding on to a good trade, and also timing to either get into a trade or to add to a trade. Okay? So he says as such a level forms, you can also get timing indication by watching the action of the stock and the potential count begins as the potential count begins to confirm the original count. A resumption should begin at this point. So think about this for a second. If you're watching a stock, let's get into this here, and I'll explain it as we get in. So here's our count. We were down here on the last in the last segment of Coco on the 25 by 1 figure count. Figure chart, and we had a projection to 2875, and it's almost there. It's at 2840 here, it looks like. So you can see that count was pretty good, and let's take a look now at a couple of things. Each time we see the markup occur, it's followed by a modest congestion area. Markup, congestion, markup. Okay? That's one way to tell the strength of a market. I got bigger moves up on the markup, and in terms of price action or reaction, I've got smaller moves on the consolidations. Right? It's also holding at the halfway points on each of those or above. So if we've got a good count here, which we do, and we're seeing this kind of action, we want to say to ourselves, let's hold this trade. Let's see, this count has a good chance now of, until information comes in that causes us to doubt this count, this should be a pretty good count. And we've got a pretty good trade here, okay? There's no in other words, there's no indications of supply. The upflow is good, the ease of movement is good. We only see modest congestion areas. Okay? Yeah, 6 o'clock, thanks. So, look at what happens here. After two nice up moves, we go sideways for a way, right? And along this level here, the 2475 level right here, we get a count of 12. Okay, 12 times 25 equals 300. We add 300 to the 2475, and look at what we get, 2775. Okay, it's 100 points less than this, but it's close. It's only 4 figures, really, so that's pretty good, and we get into... At this point, though, it's telling us that this original count is a really good one, okay? This original count is a really good one. We often see this. And you're going to see the markups, and then we go into congestion, and that congestion comes pretty darn close, lots of times even closer than this, but pretty darn close to the original count. And we would coordinate with that with the vertical line chart. And most likely what we're seeing here is some sort of a spring, okay, on the vertical line chart. And we have a confirming stepping stone count. That's pretty nice. That's pretty nice. Okay. Are these TradeStation charts or hand drawn? These are coming from TradeStation. I'm sure I'd be doing it incorrectly if I did it by hand. Well, watch the video that I did and practice a little bit, and you know, because it's a skill, and like any skill, you need to practice, but you should get it pretty quickly. Okay, so let's keep pushing on here a little bit. He had a few refinements in the technique that are important. He said that for longer term counts, you should add your count to the exact low, which is pretty much what I always do, or a point about halfway between the low and the count line. So here's our, let's just go to this here quickly. Here's our count line. Here's our low. So he said that you can add it, you add it to the low. You can also find a spot that's halfway between. He was just using this as sort of a hedge. You can take counts. The most conservative way to take the count is to add it to the low. The more aggressive way to take the count is to add it to the count line. And so Evans would do both, and so he'd have a couple of spots up here. And then he'd sort of hedge, and he'd say, but the best thing to do is to know where the midpoint is and use that, okay? Basically what he was saying is anywhere in this area, you're going to be carefully watching and monitoring in this area for signs of no demand, the trend tiring out, supply coming in, or anything else that's going to tell you time to exit this trade. Okay? That's basically what he's saying here. So I have not really found doing this to be all that helpful, but it's there if you want to try to do that. I like to be conservative, and I always use the most conservative count. Okay? This, though, is something that's really important. Counts are only points of stop, look, and listen. I told you he was kind of corny, and so he would use these little. He would have a stop, look, and listen sign in his charts. They're only points to stop, look, and listen, and should never be looked upon as exact points of stopping or turning. Don't do this. Okay? Markets can often go through counts. We see that all the time. They can sometimes stop short of them. We see that fairly frequently. They're not exact points. They're really areas. Use them as projected points where a turn could occur, and use the vertical line chart to show the action at these points as these points are approached. So, in other words, be smart about this when the market gets into this area. Okay, don't just latch on to a count and say, "Oh, I've got this terrific count, and it's going to go to the moon." Or you've got a count and the market reaches this count and you say, "Okay, let's reverse here because this is going to be the high." Do not do that. Okay, do not do that. Use your skills on reading the chart, especially the vertical line chart, in this area, to see if supply is starting to overcome demand at that point. Okay? Also, he says, in terms of kind of refinements, in the case of a longer term count, and this is important, often the last point of support comes at the original level of the climax. Okay? The climax is the last move down before the market stops. It's either coming in on strong volume or coming in oversold in the trend channel. So point A on the vertical line chart, on the Cocoa chart, would be our climax area. So lots of times the last point of support will actually come down to the level of the original climax. And the climax, when that occurs, indicates a reversal, and with cause being formed for the next projection or the next effect. When the last point of support comes at the level of climax, it usually makes it a more valid count, and I've found this to be true as well. So when we get a last point of support that then is, when we get climax, a selling climax, that's followed by a sign of strength, and then we get a reaction that's relatively weak, and we'll see that volume diminish down here compared to up here, and we get a last point of support near that climax, at or near the climax, usually slightly above or right at. That's pretty powerful, okay? But you got to have this, and this has to be weak coming down. Maybe not the first leg or two coming down, but by the time it gets to the bottom, it has to show weakness and no supply down here, okay? Now, also, this is something I see even more, is that often the climax is preceded by preliminary support, or I might say preliminary demand. And the last point of support often occurs at the same level as preliminary support. Now this we see a lot, and this is a key idea added by Evans. And let's see what that means, okay? Let's see what that means, because it really is a key idea. So here we are on Cocoa, and look at how this is continuing to go. We said around 2,800 and change, which was down around here, down around this level, right in here was where we stopped before. Okay, that was the count here in red. All right, hang on a second. Okay. Wasn't quite sure what I was looking at here in my notes. So obviously the market continued to go through there. Now we can go up. We can't. There's nothing to add on the red one here on the initial count. There's nothing to go sideways here, but we can go up to the next last point of support. Last point of support number 2. Okay, you could technically go to this little 0 here first, but and I would do that. I would look at this first, but I know that the market went further, so we would go to this point here. You can continue if the market continues up. You can go. I would now jump to a 3-figure chart, which I'll show you in the very end of this session. But you could do this as well. Okay, you have last point of support number 2 or number 3. All right. What I want to point out though is that going back to the vertical line chart, here's our last point of support. Here's our selling climax or our oversold position. This typically selling climaxes have the most volume and they have more price action in terms of downside price action here, stronger price action. Doesn't quite happen here. But notice here at C where we get this rally. It's not a stellar rally, except look at the volume. Is big and it increases on the rally. This, we wouldn't know it at the time. We have to look at this stuff after the fact. But we don't have to know it at the time. It's not important to us at the time. It's important to us when we're way over here, many bars later. But when we go back, we can identify this as preliminary demand or preliminary support. Okay? Preliminary demand or preliminary support. This is where the market started to stop in here. Notice on this rally here, we didn't quite get that kind of volume that we got over here. Certainly didn't get it in these areas here. It's when we came down here and had that, we started to stop this market. But as I said, not all markets, it's a process. It doesn't stop on a dime. And we will frequently see the preliminary demand coming in, followed by some sort of a climactic action or oversold action. Sometimes it's just no demand down here, followed by a sign of strength, right? And then followed by a weak reaction. We would call this in larger terms secondary testing, but just a weak reaction back into a last point of support. And notice where that's occurring. Think about this for a second. If the initial demand, the initial accumulation started here, and they accumulated down in here, and they accumulated up in here, and then they brought it back down and accumulated more in here, and then brought it one more time over to that level and accumulated here. Notice all the trading that's going on in this area, all starting from preliminary support, preliminary demand. When we can identify that on the chart, and when the chart is showing us that the count wants to continue to go higher, we can bring our count all the way back over to that level. Okay, that's C. This is C on the vertical line chart, and then we get 42 figures along the 227 line, 2275 line. That's 1,050. We add that to the low. Let's just be conservative, not get crazy with this stuff. That takes us up to 3175. And at this point, the market hits, it looks like it's just around 3150 or maybe slightly less, 3125. Not bad, is it? These point and figure charts. Okay, good. Yep, it is pretty amazing stuff. And now look at what happens here. Look at what happens here. Our last stepping stone count for this was back here. But look at what happens here. We continue to see markup, signs of strength, and then we get a pullback in here, then we get another markup, and then a pullback. Remember, these markups are on their own signs of strength, right? Maybe they're not major signs of strength like we see here, but they are signs of strength. and then these horizontal formations and these pullbacks are in themselves last points of support, as long as they're weak pullbacks, right? So you can think about them this way. That's what this count guide is really telling you, is that the sign of strength, last point of support, sign of strength, last point of support, that's what we keep looking for in these markets when we're trading to the long side and using point and figure charts. So we create a stepping stone a stepping stone count here. We get 22 figures along the 2675 line. And so we would add that not to here, because we have a low down here. Let's call this B. This B is 2625. That's where we add it to. And see the flag on this goes to here. That's what that means when I put flags there on these projections. So we're not adding it to this, we're adding it to this. Okay? And that tells us 3175. Look at this, 3175, 3175. It says this count, this bigger count is really valid. Okay? And then we look at what happens. We get a markup, a test in here, and then the real markup occurs there. Okay? All right, so we take a quick, let me just check my slides here, see where I am on all of this. Yeah, so here's the full count guide, both up count and down count here. The complete count guide is written. As I said before, the up count and the down counts are just mirror images of one another. They are exactly the same, except we're looking for signs of weakness rather than signs of strength. And instead of a last point of support, we're looking for a last point of supply. Okay? But we do the same thing. Phases, complete phases at one time, being conservative, stop, look, and listen. All that stuff is all exactly the same. And this is all repeated for you on the PDF in the members area. All right, yes, it is an awesome tool to have. Absolutely. Point and figure charts are amazing things. All right, let's take a 5-minute break and be back here, and then we're going to start in on the last part of the count guide that I want to talk about tonight, and that is springs and tests as signs of strength and last points of support on their own recognizance. And then we'll start taking a look at the United Technology charts and see how they all start to play into this and what they can teach us. Okay, so 5 minutes. We'll be back. It's now, let's see, what time is it here? It's 6:19, so we'll be back at 6:24, all right, or 6:25, give you an extra minute. All right, where is my, put this on pause. Okay, so now let's focus in on springs and up thrusts. This is a little secret, I suppose, if you will, in the Wyckoff method about springs and up thrusts. If you've been familiar with my work or David Weiss's work, you know we both really like springs and up thrusts. David often says that you could trade nothing but springs and up thrusts and do very well, and that's absolutely true. I will tell you that a spring and an up thrust is my bread and butter trade. I'll take them day in and day out all day long. They're so good. Now, why, you might ask? Well, Evan says in his count guide that a spring, or the test of a spring, is quite often constitutes the sign of strength and the last point of support in the same action, which is reached at the same point and at the same time. Usually a spring, and this is the same for an up thrust, okay? So a spring or an up thrust, and the test of a spring or a test of an up thrust will constitute, on the case of a spring, a sign of strength and last point of support. In the case of an up thrust, a sign of weakness, and the last point of supply in the same action, reached at the same point and the same time. So usually a spring or an upthrust will be followed by a more important sign of strength in the case of a spring. And the reaction following that sign of strength is also a valid last point of support. When we're talking about upthrusts, it will typically be followed by a more important sign of weakness. This is really important, okay? You'll often hear me say that I expect a spring or an upthrust to push through the last swing high or the last swing low, depending on which we're talking about. And when it does that, it creates a more important sign of strength or a more important sign of weakness, okay? And then when we see a reaction following that sign of strength, it's also a valid last point of support. So lots to think about here about springs and upthrusts. They are very, very important to the Wyckoff playbook. And the question here, do you take a spring after you see a jump across the creek? Yeah, if that jump across the creek is a sign of strength in its own right, followed by a spring, that's usually a very good sign. It's another sign of strength, and now we're looking for a drive up and over the swing high put in by the initial sign of strength. So yeah. Okay, so let's take a look here at I'll explain springs and upthrusts with a stock chart, and we'll move forward in time with this stock chart, seeing how the other principles in Evans's count guide are applied. So this is a daily chart of United Technologies, UTX. And so what do you notice in the middle of the chart? What do you notice in the middle of the chart? Oh yeah, it's an upthrust, right. All we need to do is draw one line and then it becomes clear, right? It becomes very clear. It's an upthrust. In fact, we have an upthrust at A and an upthrust. For those who don't know, I explained this in the video that I in one of the extra additional materials video, but an upthrust basically is a market comes up to a prior swing high, which would be here at X. This is a swing high after a reaction. It comes back up, goes through it, but can't sustain it, can't follow through to the upside, and instead comes down. Okay? That's an upthrust. A spring is just the opposite. It finds support, goes underneath that support, but can't continue to go lower and instead turns higher. Okay? So we also have at B a no demand test. We can see the volume dries up as the market tries to rally up and fails. Or what is known as a last point of supply, where the rally is meeting selling. So in the upthrust we have a last point of supply because the upthrust itself is a sign of weakness and the last point of supply. And then we get another last point of supply here after a weak rally. So let's go to the point and figure chart. See how this looks there. And here we are. A and B. Okay, these are from the daily vertical line chart. Same spots. Just you notice that the point and figure chart compresses these because we're only looking at figures. And again, on this point and figure chart, I'm using a 1 point figure chart. Okay, 1 point box size, 1 point reversal, and I'm using 60-minute data to construct this. Okay, so we can take a count here. How did I do this here? At A, which is on the 91 line, we have a count, though, on the 80. What did I do here? From A, 91.70. Oh, okay. I know what I did. Sorry. Okay, so I'm following Evans's line of logic here. So on the 89 line, we would take the count. We would start with a count here, but I didn't do that because it goes down lower. Okay, so this would be our initial count would be off of the A line over here, which would be the 91 line, and we'd create a count, and that comes probably down into about here, give or take. And the market is just plummeting down here, so we would immediately go to the next count, which is on the B line, which is the 89 line. So we have a count of 21 figures, or 21 89s across the 89 line. And this is what Evans was talking about before. You can put the count, you can take the count from the conservatively from 91 here, A. So that would be 91 minus 21 would be 70, okay, which is here. And we can also do another count here, 89 from the 89, so 89 line. So 89 minus 21 is 68. And you can see that the market falls right in the middle there. Either one is fine. I mean, gosh, you know, you get 21 points here. You'd be looking, you know, that anywhere from 70 or maybe a little bit before 70, say 72 down to about 68 is your area to get out of this stock. All right? Or at least expect a decent rally to occur. All right. Is B the correct entry for the short? No, not necessarily. There are two ways to enter up thrusts. And you can do it either on the upthrust itself, selling the market when it closes below the high of X over here, the high of that swing. And another entry would be on the test of the upthrust, but frankly, we don't always get a test of the upthrust. Okay, so you have to be. This is the more conservative play, is to take the test, and that's fine. I have no qualms about that. But probably, I don't know, somewhere around a third to a half of the time, you're not going to get a test. It's just going to go straight down from the upthrust, or it's going to give you a much lower test. Same thing with springs. We don't always get tests on springs. So that's that upthrust. Now, so the market, we were up here. I'm just going to follow this chart through. This was A and this was B. But now we have a new A on the chart. I'm pretty limited in my alphabet, and I can only go a few letters. So what do we have here at A? What do we see here? Back on the daily chart a couple of months later. Yeah, spring. Right? So we go back to the point and figure chart here. And remember, springs and upthrusts are, by definition, springs are signs of strength by themselves. We don't need, in other words, a last point of support, because the last point of support and the sign of strength occur in the spring. So the spring occurs here at A. Now we have a fairly large count, as we'll see in a moment, so we can break that down into phases. And A is our spring. We see, remember we talked about phasing. We look for the dips in here and also for higher volume. And we can see that. So we have 3 phases at least in here. Okay. And now we can go to our figure chart. And we go from A to our first phase. And I've done this out for us. So that's 7 points. Okay. Our second phase is 17 points. And then we can add another 3 points on here. I'm sorry, 7 points on if we go to phase 3. And so I didn't bother doing the first phase. This is really phase 2. What did I do here? Okay. So 67 is the low, and we said 7 and 17 equals 24 points. So to this point here, this phase. Phases 1 and 2 would get us to 91. And then if phase 3, if there's reason to believe that we're going to continue to go higher here, phase 3 would bring us up to 98. Okay, but I just tracked us in here for the time being at 91. So let's see what happens then on the, so we're looking for somewhere between 91 and 98 as our target area. Okay. Well, what do we see here? What do we see here? Yeah, we're overbought. So this is one of the instances where I was saying that we can't just take account and expect the market to go straight to it or to go, meet it. We have to pay attention to what's going on in the market. And what we see here is that we get overbought in here, don't we? We get overbought. And since this is a 10-point trend channel, if we were to look at the, from here we're at 87 and down here if we extended this up, we're about 77. So it's a 10-point reaction. The market has the right to go back 10 points on this trend channel, right? We'd like it to hold on the halfway point, but that would be about 5 points, but that doesn't mean that that's necessarily what it's going to do, because it can go all the way back down to the trend channel. So if I'm in here at 87 and I know that we're getting overbought, I'd start thinking about, okay, maybe I should take at least a piece, if not the whole thing off, because, we're at 87, 91, that's 4 points. Do I want to give up 10 to try to get 4? Probably not. This is kind of the way I would be making the decision here, okay, to try to exit it out. Well, I'd refer to the vertical line chart, and what am I seeing in here? I'm seeing that we got quite overbought twice, once here, and now I'm starting to see some pretty good action. And what would be sticking out to me like a sore thumb is this large amount of volume. And we're not going anywhere up here on that volume. Remember we talked about 3 laws that Wyckoff had? Supply, demand, cause and effect. This is the cause, this is the effect. Demand is overcoming supply. Supply was clearly in control over here. This was accumulation, the mopping up of supply and the creation of demand. And now we have what's called effort and result. A lot of effort, no result here. A lot of effort in the volume, no real result in propelling these prices up higher into 91 or so. So I've got oversold conditions, I've got problems with effort going and result. I would be taking that trade off, okay? So again, these are places to stop, look, and listen, and they're also things that we don't just latch onto and say it's going to go to 98 or it's going to go to 91. We really, really have to be monitoring this all the time and be aware of what the market is doing. Okay. And by the way, this is kind of similar to the What's the Right Trade segment I did this week. So you might want to review that video. It should be up on the website now to see what that looks like. Okay. Okay, but now look, we come back to what should be higher support, right? And lots of times we like this when the market comes down to old resistance over here and starts to stop and looks like it's going to hold. That's kind of cool, right? So we might buy that in here. But let's take a look at what happens. If we go, hang on a second. Yeah. If we go back, we're looking now at this segment on the next chart. Okay. So that's this here. Well, what do we have here? Remember that high volume? Now you can really see the effort versus result. We had good demand coming up, and then these 3 bars here, and especially this last bar, which is the largest volume, coming back down, all showing effort to go up, no result, and now supply starting to come into the market. And at this point, we have an upthrust, a sign of weakness at an overbought position in the trend channel. Okay, a strong sign of weakness at an overbought position. So we come down and we use the count guide thinking about this, okay, and we say, okay, last point of supply in here, right? After an upthrust, we're going to see a sign of weakness, and we do see that. We retrace all the way back down here, and so we have a last point of supply. But frankly, because we're on top of support, it would be really tough to make a short trade right here. Okay, it'd be very difficult to make a short trade here. Might be able to make one up here, but we might be pulling that trade off when we come back down to support, just because support and resistance can be so strong. Okay, but what happens with this? We don't see this market holding in here and rallying back up, which is what it ought to be doing if this support is valid. It does just the opposite. It drops down here, and we now have an even larger sign of weakness, a larger reaction down, sign of weakness. This support now is not really holding, and we come back up here and we see volume diminish up in here. It gets smaller up there. That's not good. Effort versus result. There's no effort behind the move up. So we're not going to get a result. And we also have an upthrust in here. And when we have an upthrust, we expect, just like we got here, a larger sign of weakness to unfold. So while we are at support, and while this is typically a spot where we might want to be thinking about going long, we have so many indications of weakness from being overbought, upthrust, sign of weakness, larger sign of weakness, a weak rally, and a last point of supply, and another upthrust. So we have to take the short trade here. Okay? I'll catch up with questions in a moment. Let me just go now and take a look at the point and figure chart. You can almost do these in your sleep, okay, by this point. We can take from the upthrust, we can go over to this point here, very conservative. We've got 6-point count. That occurs on the first sign of weakness coming down, right? Then we have last point of supply number 1 here. We can take that count across. That's 12. That would take us down to 75. Okay, not bad, but we don't know about that support yet, and so we might hold back. But then we get a larger sign of weakness again coming down, and a last point of support number 2, last point of supply number 2. We can take a count across that line, and now that's 19 figures, 19 on 8, across on the 82 line. There's 19 82s going across here on last point of supply number 2, and that takes us down to 62. So somewhere in this area, we have counts that go from 75 to 68. We're at 82. That might be good enough for a trade with all that weakness in the background. And then we get the mark down, and we come somewhere in the middle here, and we start to see the market hold support. Okay? So using point and figure charts can be very helpful, even even when we think we know, well, we're at support, you want to be open-minded and assessing things very carefully. Okay? Okay, there was a change in behavior. Yep. Yep, there was, Lars. Gary, don't you want the upthrust closing close to its low, or is the middle okay? We'll go back to that slide. Here it is here. It's closing on its low there. Okay, so that's fine. We can go back even further, probably to the other upthrust, way back. We'll get there. And I would look at this and I would say gap down, gap open down. I don't care that it's closing on its sort of in its middle, it's in the lower third, but that gap down tells me the supply demand imbalance. I would have no problem taking that trade at that point. Okay, no problem with that. Okay, now I forget where we were. See if I can get us back to, talked about this. Yeah, okay. Okay, now, all right. There's a point I wanted to make here because I think I made a mistake on this and I wanted to. Okay, taking the count off of the last point of supply number 2 line along the 82 line is actually incorrect. And why is that? Well, because we hadn't exhausted the count from number 1 yet. Instead of using the second last point of supply distribution at the 82 line, we really want to subtract these 12 points along the 83 line itself. Okay? So we want to subtract them from 87, that's the conservative, but also before we go to this, subtract them from the 83 line as well. Okay? And that would give us a projection to 71. That's this red flag in here, and that's basically where the market stops. Okay, so we always want to do that. We want to use the complete counts first, and then we also want to put, before we go to the next phase, do that, put it off of this line here. That's the proper way to do it. Okay, I just wanted to highlight that as a little mistake I threw in there on purpose, so that we didn't overlook that. Okay, so the market then comes down to A. This is that 71 area, right down here, and then goes sideways. All right. We have broken any downtrend lines that exist here. We've rallied up now. We start to see demand coming in, or the volume coming in on the demand pretty nicely in here. So we have a sign of strength. And then the market kind of meanders along for quite some time. And this is not unusual. If you're doing position trades, this is you might only get 3 or 4 opportunities, really good opportunities in a year. Okay? But we come to a last point of support, the volume recedes, okay, and we have a spring occur here as the market closes above this swing low. And you can see the volume over here and the volume over here, much lower down here, okay? And that's one of the things we look for. It's not absolutely necessary, but it's something that we do want to look for. So we can go to our vertical line chart. I'm sorry, to our point and figure chart. We can break it down into phases. You can certainly see that there are good phasing opportunities in here, and they show up over in here. And we create that last point of support, which is also a spring, kind of a double shot there. And notice how quickly the market takes off from that. Look at the markup occur. It's beautiful, right? I won't go through all of this because I want to get into the other charts that I've got. But you get the basics here, that you take the count, and even from here you would still do the conservative count off of the 71 line. Once all of that gets exhausted, then you can come up to the 75 and look at it that way as well. Notice what happens though. Here's our initial, I didn't put the flags on here, but here's our initial projection. Well, let's go back for a second. Otherwise, I'm feeling like I'm not doing it right. So from the 71 line, we get a count up to of across here is 44 points, and that would bring us up to 115. We've got other phases along the way, but that would be the full phase, okay? All phases. So let's go to now, we look here, and we get a stepping stone count along B from the 91 line. That would bring us up to 117. So 117 is basically the same as 115. I mean, I don't see a whole lot of difference there. And notice how we get not just nice markups from this last point of support, but we also get a nice markup from this stepping stone point and last point of support. And that's what we would expect. If you don't get this, the market continues to go sideways, then you will probably are doing something wrong and you want to get yourself out of there. So here's what happens. Actually, we had a count all the way up to 119, I guess. But we can see that the stepping stone count brings it right up into this area, and the market does go up into goes up into the high teens here, 120 it looks like. So you can see how effective this is. Okay. Any questions on that? Here's what the counts look like. I kind of outline them here just so you get a sense on the daily bar chart. Okay, so this was A down here, and this is B over here. So you can see the sign of strength, right? The weaker reaction to a last point of support, sign of strength. I'm sorry, not weakness. Get sign of strength. Sign of strength over here, last point of support. And that should lead to more sign of strength. Okay. Notice too, we don't really get, we might have a count in here and maybe in here, but if these counts, if we're coming into these counts here and that we've got two good ones, don't go too crazy with this stuff. You know, you might have a count, let's say you have another count that might take it up to, I don't know, I'm going to make up. These were like 117, 119, something like that, 115. So let's say that these were our counts in here, and now you can create a count that says 135 or 140. Well, you could tuck that away in the back of your head if you started to get strong movement up, but look at the strength. Look at this strength. Look at this strength. A little bit less here. Do we see the same kinds of strength coming in over here? No. It's telling us that the market is tiring out here and starting to roll over. We're not seeing the strong markup. We're starting to see a shift in, or a change in, the character of the market. The buyers are just not as strong. They're just not willing, just don't have the, can't buy anymore, maybe up in here, or are unwilling to. we'd be wanting to look very carefully at these high volume areas. Are these showing us either effort to go up with no really good result, or are they showing us that these are coming in on the downside? If they are, could be supply coming into the market. So we want to pay attention to that. Just because we get counts doesn't mean that we're going to go there. You have to use them prudently. Okay? All right. Will I show any Forex charts? Well, I'm going to show the British pound in a minute. It's not Forex, but it's the same thing in reverse, right? Same thing upside down. Could you please repeat why you add the top of the absorption to the left of the stepping stone? It's just being conservative. We want to exhaust the full count. And exhausting the full count, we start off conservatively by adding it to the high point in an up thrust. And if it's in a spring, we add it to the absolute low point. That's being very conservative. We can also add the count to the line that we take it from. So let's go back just to make it easy here. Okay, so I can see this. So I'll go back one more. Yeah, okay. So A here is our low point, and that's 71, okay? So we add the 44 that goes across here, and we add it to 71, and that gives us 115. All right, that's the conservative count on this chart. We can also, if the market tells us that this is okay, we can also add that 44 to 75. This is the 75 line, right? We added it first to 71. If the market's still pushing up, we can add it to the 75 line, and then that would give us 119. And we do this first. This is the 75 line. We do this first. That before, let's say we were going to take a count, the market was still going strong and we wanted to take a count across here. We do this first before we start adding this. And let's say that this is, I don't know, 55 figures across. So then we would add 55 to 71 and we would get 126 from here. And if that continued to push up and it looks like it was going to, and the market was still strong at that point, and this is at the 80 line, and what do we say, 50 points or 55 points? So we would add it to the 80 line and it would go to 135 or whatever the number is. Okay, that's how we keep doing it step by step, but we do it conservatively. That's what I meant by that. Okay. Can you go over the little mistake on purpose for? Yeah, well, it's just the same thing. I went to the next line here before I exhausted this. Okay, so it's just the same thing here as I did before. So going back here. So here, forget the numbers. But we had 12 points here, and we subtracted from 87. This is the 87 line, 87 level. So 12 from 87 brings us down to 75. That's here. Then what I did is I said, okay, well, the market's clearly going down here. Let's go and jump to this. Okay? And I said, okay, there's 19 here, and we subtract that from 87, and that brings us down to 68. But this was wrong. Why? Because before we get to this and this count, we've only done the conservative count here. So now we want to do the more, I don't know, liberal or aggressive count. This is along the 83 line. So we subtract 12 from 83, and that brings us down to 71. And then the market stops in here. Okay? So we do it that way first. If the market continued to go and wanted to push down, then we go to this one here. Then we go to that count, and then we're down here to 68. Okay, and then what we would do is we would add 19 or subtract 19 from 82, and that's going to give us what does that give us? Oh my gosh, I can't think. I'm wiped out now. But you get the idea. Okay, so that would give us a lower count down here. All right, good. You got the idea. Excellent. Do that part of it methodically, mechanically. 63. That's it. I knew it was somewhere around there. Do that mechanically if you can. Okay. But you get more counts. How is that conservative? Because we've exhausted that. That's why it's conservative. Okay? We've exhausted the conservative, so we go to the next conservative level. Any reason why counts work, or is it just empirical? I think it works because it's related to the amount of accumulation that goes on in a chart, and that's all. It's or distribution if we're on the top of a chart, on the top of a trend. You can eyeball this stuff on a vertical line chart too, and you know, used to know a trader who would put his thumb on there and kind of get an inch or two of sideways movement, and then turn his thumb 90 degrees and mark it off on the chart and say that's probably where it's going to go, and he was fairly accurate at that. So I think there's a function of amount of time spent in the area and amount of space that is taken up in terms of points accumulated and points distributed. And the point and figure chart is just a simple way to measure it. But boy, oh boy, is it effective. It's pretty uncanny. So anyway, I mean, that's the best explanation I can give you. I don't know if it's accurate or not. All I know is that it works pretty well. Okay, so let's now go into the intraday. And now I'm going to probably blow your minds with a couple of things here. But we'll go to the intraday. And we're going to use the British pound futures. I like that better than Forex. I know a lot of people like Forex, but I tend to like the futures better. But you're going to see that this is very useful. And the Forex charts just look like this upside down. They're just the reverse. Because this is the British pound futures, and then the Forex is the cable, the British pound to US dollar cross rate. I'm seeing Elliott wave patterns here, also with point and figure. It also works pretty well if you know it like this. This is amazing stuff, says Steve. Yeah, you know, Elliott, boy, oh boy, it's Elliott. I studied Elliott I hired a guy who used to work for Robert Prechter to teach me Elliott wave stuff. And I think, you know, if you're right about the counts, it can be terrific. But boy, oh boy, if you're not, you get yourself in all kinds of trouble. I don't know. I use some things from Elliott. I love the ABC retracements, but once in a while I'll look and see, you know, okay, we got 5 motive waves to the upside, so now I'm going to expect some sort of a complex reaction. And I use the idea of alternation between reactions, Steve. But beyond that, I really don't try to think in Elliott terms. For me personally, it was always a bad idea for me to do. So I do use it, but only extremely selectively, and not as an Elliott kind of guy, if you will. David Weiss is an expert in Elliott wave theory, and he will do Elliott wave analysis, but even he will say that sometimes I have to really turn my Elliott wave eyes off and just think in terms of Wyckoff, because Wyckoff is so much more powerful than Elliott. So that's coming from somebody who wrote a book on it, in fact. years ago. But anyway, I don't want to get off on a tangent there. It's just the if you like Elliott wave and you're good at it, you know, as we used to say in the 70s, more power to you. I don't have any, you know, I don't ever try to dissuade anybody from doing it, just that I couldn't really do it very well. ABC waves are all over the chart, says Steve. You're showing where C equals A, middle of VP yesterday, right now. Yeah, I'm sure. But if I go there, I'm in trouble. So you'll have to bear with me. All right, so let's take a look at the British pound on the intraday. Now, I'm using, this is a 1-by-1 figure chart, but it's not a 1-by-1 figure chart in the way that you think that you're thinking about it. I'm breaking this down so that the one box, that each box is 0.0005. So it's five pips basically on this, and then the reversal is 1. So I'm just setting the box reversal to a smaller number, because if I set it to 1, we would see 1 or 2 boxes on this whole chart, right? Because we wouldn't get any movement, because it takes a full point to move. We would see 1 box. That would be it, 1 figure on this whole chart. So you have to break it down, okay? So don't get excited about this. Just break them down. Just kind of eyeball it. Do some trial and error work with yourself, and see what looks like it works well. That's a much better way to do it than me telling you that this is. You can change this around. You can have 0.005 and 2 zeros and make it a 50 pip chart rather than a 5 pip chart. Or you can make a 10 pip chart. It doesn't really matter. This is just good for, this is nice and sensitive for day trading, okay? So again, I'm using 5 pips here and a 5 pip reversal, okay? I'm just times 1, that's a 5 pip reversal. So what do we see here? Let's take a look. Well, there's some questions. Let me just get those out of the way here. On the intraday, the box size changes, but all other input fields remain the same. Generally, that's true, yes. I'll show you an instance where that doesn't, but that's right. Don't think about that, though, until I get there. And then some comments about Elliott wave. And so, okay, let's go on here. So what do we see here? Immediately, what do I see? I see, let's add some structure. First idea that always pops into my little head. And I can see that we are overbought in the trend channel, and we have an upthrust. Oh my goodness, right? How good can that be? Now, remember, we're trading this intraday, so I'm going to look on the daily chart. Okay, now let me just, so those folks, just to orient you here, when I look at intraday charts, I like to use tick charts because they compress the overnight data, and now I get good, smooth charts. If this were just a 5-minute chart or a 10-minute chart or a 15-minute chart, whatever this would roughly equate to, which is probably between a 5 and a 10-minute chart, you wouldn't be able to draw these trend channels and stuff so nicely. That's the value of using ticks. Ticks are nothing more than bars being built on activity. So each bar here, this is a 750 tick bar chart, so each bar is 750. Technically, it's price changes, but you can think about it in terms of trades. 750 trades occur, and a bar gets painted. Then we go on to the next bar. 750 trades occur, and that bar gets painted. Of course, as you know, we're looking at this real time, so just like a 5-minute chart, it's being painted real time. But once 750 trades have taken place, it goes on to the next bar. It's not time bound, if you will. It's activity bound, which has lots of positive things to it. The other thing that you'll notice about this chart is that we're using what is known as the Weiss wave. This is a phenomenally wonderful idea, steeped deeply in the Wyckoff method, that was created by David Weiss. Basically, what the Weiss wave does is it measures the waves in the market. We'll talk a little bit about them in a moment. And it also looks at the wave volume. So this is the volume. This green little triangle type thing here is the volume from the low to the high of this swing, or what we call wave. Then we come down, and that's the volume associated with this wave. Okay, we go up. This is the volume here. We come down only for one bar, and that's the volume associated with that down wave. Then we go up, and so on, all the way across the chart. So one of the things that I notice here on this chart is the same things that we saw on the point and figure chart. We have a overbought condition, a trend that had gone on. It got a little parabolic up in here, and then it got overbought, and we see the market rise straight up in here, and up thrust, and that straight up rise and then gets retraced. That's hypodermics. We talked about that last time, and there is a definition of that in the members area in one of those videos. This is a hypodermic. We wouldn't know it as it was occurring. We might suspect it. Pretty good volume coming in on that, so I don't think we would suspect it. I would be expecting this price to try to go higher and maybe create a new trend channel, but it doesn't do that. And as we come down, even though we're not getting strong price action down, I'm seeing volume really, excuse me, really come into the downside here. So there's a sign of weakness in the upthrust itself. That's going to create a larger sign of weakness, and that's what we're starting to see down here. We're starting to see heavier volume coming into the downside, and we see a larger wave down, or a larger move down, larger swing down than we saw in the past here on these down waves. So these are indications of signs of weakness in the market. So we can go to a point and figure chart. I'm going to do this kind of a little bit more shorthand, because by this point you should have a pretty good, I'm not going to go through and count and show you all the, there are these many boxes across. We're just going to, you can figure that out if you want to, but you get the idea. We can take a count across the A line and it comes down to 53.90. Market doesn't come quite all the way down to that level, but it surely shows us a sign of weakness in here, right? Because now we're making a lower low and we're going straight down. The swing, or the wave, is much larger coming down. And we go back up to the vertical line chart, and we see that the wave volume is increasing to the downside as well. So there's good indication of supply and sign of weakness. So, and there it is. Okay, so here's this. I didn't realize I had this chart. So here's clearly there's a sign of weakness coming in. This is, the top here is A, up here. Okay. So I can actually do point and figure charts off a tick chart. You can, at least in TradeStation you can, but I'm not doing it off of a point and figure tick chart. This is off of a 15-minute chart. I'm just taking the swings off of a 15. I'm taking the data from the 15-minute and applying this box and reversal size. That's all. If we did it off of a 750, it probably would be a little bit too much data. You have to kind of play with it a little bit to how about volume charts versus tick charts? Well, why would I want volume charts? Because that's telling me price bars are all the same volume. So that takes half of my data away. I would never do that. Never do that. So we have a test of that upthrust here, or at least a last point of supply before we start the down move. So we can make a count here as well. And that brings us down to 1553 from the conservative, 5350 from the conservative level of A. Notice now we've got a projection down into this area here, and what do we get? We get an upthrust. And then we get a sign of weakness, and we get another last point of support in here. So now we have a good count. That upthrust occurs here. I don't know why I called these letters and those numbers, but you can almost see the upthrust here. And we have this count, and now we can create, after a sign of weakness, we get another last point of supply. And we have what do we have here? It's a stepping stone count, confirming this larger count. And that's pretty nice. That's really nice, right? Everybody see this? I want to make sure that I'm explaining this clear enough so that you're getting it. Is this registering with people? So even off of the intraday, the Bob Evans's count guide is, really good. It works really, really well. Okay. So we have entry points on this trade of 1 as an upthrust and 2 as just a weak rally. Look at the volume down here. This is where the Weiss wave really excels. We just don't have strong volume coming in to the upside, and the price action is not very strong either. So now our projection is let's go back for a second. So our projection actually is pretty close in here, 5360 to 5350, and it goes to 5355. Okay, but we're down here at 3, and what I notice is a couple of things. You pair the two charts together. This is how you use them. We draw a trend channel in, of course, right? And we're getting down into the area where we're oversold. I'm seeing positive price action in these couple of bars here as we're down at the lows. And I'm not seeing any supply. This is no supply down here. Okay, no supply. And I'm in the area where the count is exhausted. And I've got a confirmation count or a stepping stone count that's exhausting as well. So it's telling you this is the spot to take your trade off. So time to exit out, right? Okay, let me just get my... Okay, so we get a rally off of that. Now notice there's no count really to go to the upside, so we don't make one. We don't try to create something out of things that don't exist. But when we get up here, we start to go sideways, and at D, we get another count here. Why? Because it's an upthrust. Does this make sense? Is this really a last point of supply? Well, yeah, because we make a lower low. We have another sign of weakness. Remember, when upthrusts occur, which they did here at C, we typically see it result in a greater sign of weakness. So now we come back up here to another potential last point of supply. Okay. And if we look on the vertical line chart, and this was where our count exhausted, as we talked about before. So we get a rally up. Looks actually pretty good. We break the supply line and all of that. But then we go sideways into looks to me like the Asian session. And we get no more demand up in here. And so we get an upthrust. and we have a count. So it's worthwhile taking a shot at that. And as we come down, I see volume building to the downside. So that is a positive sign. If I just saw small volumes and kind of sideways movement, I'd scratch out of the trade. But here we don't have that. We get something halfway decent. And our projection is down to 53.65. We come down to about 53.60, give or take. And our count is confirmed. Now, something I wanted to point out here, I don't want to spend too much time on this. It's not as it can be pretty important. When we see signs of weakness, one of the things we can look for is this thing called a slab-sided formation. And basically what it is, we'll see them in downtrends, we'll see them, and we have a bit of a downtrend. We're making a lower low and a lower high and a lower low, lower high, so on and so forth, right? So we do have a bit of a downtrend, although this really is kind of compressed. It's really in a trading range. But a slab-sided formation will basically, the best one here is D, where there just is no ability to rally this market, particularly off of support. And we see this level of support and there's no ability to rally. And so we call it slab-sided. Same thing here. We have support here, and same thing in here. We have support, but we're not able to rally off of that support, and we get what's called a slab-sided, or just we can almost draw a trend line down from here. It just when we have a sign of weakness, or we have a downtrend occurring, watch for these slab-sided formations to occur in here. They can be very telling. They can help confirm that the weakness is continuing and showing you that there's just no ability to rally. Do not use them in uptrends or when there's a sign of strength in the background. Okay? Point D cannot go up because of background. Would I agree? Yeah, generally. I mean, we're making lower highs in here, and we're hung up in congestion, in resistance in here at C, and the supply from B. What I kind of see in here is that this whole level here, probably preliminary supply, if we were to look on a chart, probably preliminary supply, and we came under it, came up above it, came under it, came up to it, down, up. We're just kind of rotating around here with something we call an access line. But we're just kind of rotating around this level here, this whatever it is, 544 level, 5440 level here. And just having resistance coming in. So it's not a surprise to get a count off of that at that point. I think the rally on high wave volume before D is confusing. Yeah, it would be a little bit. As I said, we would kind of see this as demand and going forward. And so you would be thinking about that. And you might even take a trade here. You might say, oh, there's a spring, let's go up. Let's go long, okay? So you go long here. And the next couple of bars are good, and then we get an upthrust. And we're getting an upthrust at the same level of supply from the day before. That's not a good sign. And then the market comes down, and then it can't rally here. It's showing you right in here, unable to rally away from the danger point after making a new low here. So you would at minimum, you'd be out of your long trade here. And you know, if you're working the point and figure charts and you're looking at this and thinking in terms of signs of weakness and signs of strength, you got this upthrust in here and no ability to rally off of support. So this is a spot to go short if you're not short already. Okay. And you got a good count to the downside. you've got a good count to the downside. And here, you don't really have a good count to the upside because you'd have to take whatever this count is in here and project it off of this low. You understand? We want to be conservative, right? So we would take phase 1 in here, and you want to try to, well, you might project it, but even here you don't. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. So you've only got phase 1 goes to here on this. You project it up, and it goes and it meets phase 1. We talked about this in session 1. Go back and review that when we looked at some of these small counts in here going back and forth. So you don't really have reason to think that this thing is going to go up higher at that point. And the market is showing you by an upthrust at that stage that it's not going to go up higher, that it has exhausted that count. And then it starts coming down. And then you start getting the big volume down. Okay. Is a slab-sided formation like an apex? Kind of, but really what it's telling you is no ability to rally. That's more important there. What makes it challenging is that the sign of strength between point C and D. Yeah, we talked about that, I think. The slab-sided formation tipped the hand to the shorts. Yeah, a little bit. More so the upthrust, though, you know, and looking at this kind of objectively. I'm not sure I'd be dare taking a sell trade on D. Yeah, well, we've talked about it. Okay. Will you give us typical recommended box sizes and reversals for the Forex and the main items like gold? I don't really want to, truthfully. I'd rather have you do that yourself. I think it's a better thing. I could do it, but I think it would be better for you to work it out for yourself, do some experimentation, and see what fits best for you. There is no correct box size for any given market. What I do on my charts, you'll see David Weiss do something totally different. He might use a different config. In fact, he does. He uses closes. I can tell you that already. He'll use a different configuration than I'm using. So kind of look at what I've done here. My recommendation to you is to kind of look at what I've done, and then you know, look at some of the, if you're really stuck, look at some of the free stuff that we've done recently. I've looked at the pound, the cable, I've looked at oil, I've looked at on the additional materials, there's the S&Ps intraday. There's also crude oil. So in fact, everything that you're asking for, or most everything that you're asking for is there. And for the stuff that's not there, I would really urge you to put in the effort and come to the things that you find comfortable. Okay. Let's see. I've tested a lot of software and only TradeStation seems to do point and figure correctly. That could be, Linda. That could be. Bullseye Broker is another one that I know does it. And I don't know about other softwares. I'm sorry, I just don't know software. I know there's a lot of software out there, and I know people want to use these different softwares, but frankly, if they don't do the stuff that you need to have them do, stockcharts.com is another one. But if they don't do the things that you need them to do, I mean, to me, it would be a fairly easy choice. Why do I stay with that software? I've been using TradeStation. I don't have any relationship with them at all, but I've been using TradeStation since 1999. David's been using it. I can tell you that David uses TradeStation and he uses Metastock. And he uses Metastock because it does a few things that TradeStation doesn't, which is to make bigger, like annual and quarterly and 5-year charts on on some of his commodities that he trades cotton and I don't know, another commodity for as like a hedge fund for a private investor group. So but that's it. He uses those two charting softwares. You know, I don't have any affiliation with them, but gee, they work. These charts work really well. I never have a problem with TradeStation. So that's about all I can tell you about software. NinjaTrader does point and figure charts well. Yeah, I don't know, truthfully. Stock Charts does it. That I do know. TradeStation is somehow not open to those living in Canada. Oh my God, I'm sorry. I can't change the Canadian government or the laws there. You know, I don't know what to tell you. I'm sorry. Go to try stockcharts.com or Bullseye Broker or one of the others then. Okay, and Ninja allows you to chart the Weiss wave on point and figure charts, and that's nice. That sounds like it's a good thing. Okay, so let's take a look. Let's go back to the charts here for a second and get off software. So here's a larger. You know, here we are on the British pound. And although we had all these nice little accounts and stuff, we're really going sideways in here. And we're in a large trading range that is going on for 1, 2, 3, 4, 5 days here, 6 days probably in a row. Okay? So there's a limit to these smaller time frame point and figure charts. At some point, it becomes really hard to use them. Okay? So Wyckoff knew this too, and he would advocate that you use a 3-point, and in rare cases when the stock chart was, you know, several $100, $600 or $800, maybe a 5-point figure chart. And truthfully, I never saw a 5-point figure chart on a stock from any of the Wyckoff material that I can remember. Certainly saw a lot of 3-point figures. So how do they construct those? Well, you already know that a 1 box by 1 reversal creates a 1-point figure chart, right? So a 3-point figure chart is pretty much the same. It's a 1-point box size, but it requires a 3-point reversal. And that's a 3-point figure chart. Okay. So here we have we're using a 5 pip, which is 0.005 by 1. So that's a 1 point or a 5 pip point and figure chart. We want to get to a 3-point figure chart or a 3 pip. A 3-point figure chart. So all it is 0.0005 times 3. And if I do my math correctly, I think that comes out to be, instead of a 5-point figure chart or a 5 pip figure chart, it comes out to be a 15 pip figure chart. Okay. So you can expand this. I'm not sure I want to say this, but I guess I will. If you were looking at long-term, if we were looking at say, intermediate swings on the S&Ps, the S&P 500, the ES, I might use a 5-point figure chart, and I would do it as a 1 by 5, okay? And that would give me a 5-point figure chart. I might also want a longer term figure chart, okay? And now I would change things on you a little bit, and instead of using a 1 box, I would use a 5-point box and a 3-box reversal, and that's going to give me a 15-point figure chart. And that would be for large swings in the S&Ps. All right. just kind of giving you ways of thinking about how to do this. If you run into questions about this, send me an email, but try to work it out for yourself. Stick with the 1 point and the 3 point. Don't worry about this for now. Stick with the 1 point and the 3 point. So, okay, so let's go back to this now. What I said was we're using a 0.0005 or a 5 pip by 1. And now we're going to do it by 3, and that's going to equal a 15 pip. Okay? So let's see what that looks like. And this is it. Okay? So it's 0.0005 times 3 times a 3-box reversal. So what that means is instead of each of these being worth 0.0005 or 5 pips to a box, they're now 15 pips to a box. It's the same thing. You're going to count across, and instead of multiplying times 5, you're going to multiply times 15. Okay, does everybody get that idea? Does that make sense to everybody? Yes, okay, good. If you use a 3-point box and a 1-point reversal, is that the same as a 1 by 3? No, it's not. It's totally different. You need to use a 1 box size and a 3-point reversal or a 3-box reversal. So we can do the same thing here. We've got the up thrust, we've got a sign of weakness. Now we've got a last point of supply here, right? And we can take the count across here, and I've done this out for you. So there's 29 figures along the 5440 line. So 29, now each one is worth 15 rather than 5. So 29 times 0.0015 equals 0.0435, 435 pip type move here is what it's projecting. So we would subtract that from the high here of 1594, and that gives us a projection down to 1.5055. You can see that here. And the market comes down a little lower than that, but it comes down to basically that point. All right. Would I use those numbers for swing trading or day trading? The 15 point, I wouldn't use it for really trading. I would use it for tracking the overall trend of the market and overall congestion in the market. For swing trading, I'd use a 5 point on the S&Ps, as I described, a 1 by 5. So looking at this as on the intraday chart, we can see at 6 we break down through support, and now so just start piecing this together. We're breaking support, and we've got a large count, and I'm looking and I'm seeing, oh my goodness, look at this volume to the downside coming in. So now you want to make a play and you want to try to press it. You basically, and oh, by the way, I'm now using a 1500 tick chart because the 750 was just too big, right? Too small. I couldn't fit it all on here. But we've basically been in a trading range in here, and now we're breaking down through it. And I've got a large count coming off of here telling me it's going to go down to this point here. So, and now I'm starting to see big volume coming in, and on the rallies I'm not getting any volume, and on the reactions I'm getting big volume, and on the rallies hardly any volume. So I want to set myself up to make trades off of this, okay? And you know, just using the basic Wyckoff concepts. We put in a trend channel when we can. We wouldn't be able to do it until we're at this point and we're starting to turn down. But before that, look at what we have. We have a point of support here. Market comes through it, and now it's coming back up again. So here's a good trade right here. And now we get a trend channel going. We've got another good trade here. And I keep seeing no volume to the upside coming in and big volume to the downside. I got another trade in here. Or I just make one trade here and I hold it until we get that climactic plummeting action and the market goes sideways. It allows you to get out gracefully, you know, very nicely. So what was the countdown to? Go back to that for a second. 55. So the count was right down to here. Whoops. Right down to somewhere in here. That's not bad, huh? That's not bad. You don't have to get in right at this point, or even at the break here. You got opportunities, and you know, here was your best opportunity to get short. Right in here. And if you're in the Asian session or the European session, here's a perfect spot. The first pullback after a breakout. That's nice. You know? So, let me just do a quick review and then we'll take some last questions and call it a day. We've gone through, in these 2 nights, these 2 sessions, each of which is turning into about 3 hours each, and the, I don't know, hours worth of additional material that I put in the members area. We've gone through all of the fundamental techniques that Wyckoff used in point and figure charting. There are some more advanced techniques, but frankly, this is plenty to digest here. You've got, we've gone through how to coordinate, which is the key thing here, the vertical line chart with the point and figure chart. We've talked an awful lot about Wyckoff principles and how to bring them into both the vertical line chart and the point and figure chart and use the two together. Particularly this idea that we're going to see a sign of strength and then a last point of support, and that's where we, you know, bring both together, bring both types of charts together, and make our counts and make our trades. We've taken a very conservative approach. I'm not telling you, you know, oh, here's a really aggressive trade to make and all of that sort of thing. Even on the last chart with the British pound, as I say, we don't have to, if you know the direction of the market, and now through your point and figure work, you've got a pretty decent idea about how far that market is going to go. Gosh, it really doesn't matter where you get in. You know, so what if you don't get in at the top tick? Who cares, really? If you know you've got 400 pips plus on a move, and you know, 35 or 40 of them, or even 100 of them have been expended, but you still got another 300. Gee whiz, what else, right? For day trading, that's pretty good. So that conservative approach is a very good approach. And remember what I said in session 1, that the figure point chart, the figure charts, the point and figure charts, by using a conservative approach, are protection against ourselves. Okay, against our more, you know, against things that we can do that can damage the account. The point and figure chart really helps us protect ourselves. So we've looked at stocks. We've looked at, you know, a commodity that I'll bet no one trades, cocoa. We've looked at the S&Ps, which probably most of us trade, or many of us trade. And we've looked at a currency, which if you don't trade the S&Ps, you probably do trade the currencies. So we've looked at, you know, pretty much the gamut of the market. And you saw in all cases that these point and figure charts, and sometimes they don't work. On that, the UTX example, where we had a projection, I think, to, what was it, 91, and the market only goes to 86 or 7. But what I tried to emphasize is that we want to coordinate both vertical line chart and point and figure chart and be aware of what's going on in the market when we start to approach those levels. And sometimes that's not going to, they don't work. But they do work pretty well most of the time. And we also note that they get particularly powerful when we have that stepping stone confirmation count, which not only gives us a good sense of where the market's going to go and should increase our confidence, but it also gives us a nice timing tool as well, because they're going to the stepping stone count is going to be coming to an end around the same level and be projecting, having a count to project around the same level as the initial point and figure chart. And so if we want to take a trade because we haven't been in the market, but now we are interested in it, or we're in the market and we want to add to the position, that's a very useful tool in doing that. We've looked at both swing trading and intraday trading. We did some extensive discussion of Bob Evans's count guide, and we've even looked at larger counts. So I've covered a lot of ground here, and I would encourage you to study it and go through charts on your own, different markets on your own, and start getting comfortable with this point and figure charting and coordinating it with the vertical line chart, and start practicing it so that you've got a good handle on it, because they really will be very useful for you. All right, let's see. One last thing I want to say is that I'm going to send out in a day or two a course evaluation. It's just maybe 4 or 5 questions. I ask you to take it, copy it, and paste it into an email, and then send it back to me with your comments. I would really appreciate it if you would do that. Please do it, because that really helps me out in understanding how to teach stuff to traders and to see where I did well. I would like to know that, but I'd also like to know where I fell short and can do better next time. So I really would appreciate it if you would do that. And I want to thank you all. But before we end, I want to take whatever last questions you have, and then we'll call it a day. What's my email address? You'll get an email from me, Charles, but it's drgary@tradingpsychologyedge.com. And I think it's on, for sure, it's on the last page of the first session. I thought you said 0.0015. I did, and I think I explained that. Can we use normal indicators for point and figure? Like what, KK? You mean like MACD and that sort of stuff? Moving averages? I don't think so. I've never used them that way. It's not the way we would use it in Wyckoff, if that's what you mean. We only, use point and figure for what they're designed to do. Did Wyckoff use close or high-low in his point and figure charts? He used high-low. I got here late and missed the first seminar and need to view it. I question the cost of this course. And it was worth every penny. Took Douglas's seminar back in '93. Love your work even more. Well, thank you. That's nice of you to say. Thank you. Have I read Jerry Duplessis's work on point and figure charts? Nope, have not. Just Wyckoff stuff. Good. I'm all the way from sunny Australia. Where are you in Australia, Fitzroy? Are you? I was in Sydney a couple of years ago, doing some teaching of trade. You're in Sydney. Oh, I love Sydney. We stayed at Avalon Beach, in the north part of, just above Sydney, in the north of Sydney. What a beautiful place, my God. If you guys weren't in such a cockamamie, yeah, the northern beaches. And we went to that famous beach, I forget what it's called, the White Palm or something, where yeah, we went to Bondi, yeah, but no, I'm talking about there was a popular Australian TV program that took place on a beach. Palm Beach or something like that. I forget what it was called. White Palm or something. I don't know. We were there too. It was beautiful. Absolutely loved it. I really liked Australia so much. Difficult topic to teach. Yes, it is. It is hard to teach because no one gets it. No one gets it took me a long time too. Do I know who invented point and figure charts? Some guy by the name of Green, I believe. And they were invented in the mid 1800s or around from 1850 to 1870, 1880, something like that. Wyckoff did not invent them, but he used them extensively. I checked Wikipedia, but there's nothing earlier than 1890s. Oh, that's possible, yeah. Wyckoff, I know, came to Wall Street in the late 1880s. He was just like 14 or 15 and was a runner at that time. I don't know when he started using point and figure charts. They were used exclusively at that point. In fact, vertical line charts didn't come into play until after the turn of the century. And then a lot of guys wouldn't use them because they thought they were very suspicious of regular, price bars and volume. But Wyckoff was one of the early adopters of vertical line charts. However, before that, he extensively used point and figures. And in fact, in a lot of ways, you could say he was more of a point and figure chart kind of person than he was a vertical line chart person. Though he was certainly great at both. Palm Beach, that's what it was. Yes, that was beautiful. Well, we may be coming down there in the coming year. I'm not sure about that, but we've talked about coming down there, going back down under. And if we do, we'll definitely be going to Sydney, I'm sure. And I'd like to actually get to Melbourne and see the Australian Open, but I know that the guys that I would go with are not tennis fans, so that's probably unlikely. Do you trade longer term as well as intraday? No, mostly it's intraday. It's hard to do both at the same time. Yeah, I find it hard to do both too. I have some very long-term positions, but that's not, I don't really trade those. Those are they're just long-term positions that I don't touch until the fundamentals change. Let everybody know tomorrow is a Fed day. Is it? I don't even know that. I haven't done any homework yet for tomorrow's trading. So how do you log into the site to view the other videos? Well, let me show you how to do that very quickly. I'm going to bring this down so that it's in the... Oh, come on. Why is my webpage not available? Well, there must be something wrong with it. I'm not sure. Oh, show saved copy. Maybe I can do that. Let's see. Let's give it one more shot. Let's see. Okay. No, I can't do a save copy either. Oh, son of a gun. Well, I can't. You should be able to log in. There's a login page. I apologize for that. But you should be able to log in and then go to premium content. And in premium content, it'll list whatever courses you have with us, and point and figure charting will be there or should be there. If it's not there for some reason, contact Helen at tradingpsychologyedge.com, or just go to the on our page that has the contact form. Just fill that out and send it in, and she'll set you straight. All right. Last questions here. How do you? Okay, hang on here. How do you log on? That happens for you? Yeah, I don't know what the problem is with this. I've got to check that. We've just changed a lot of things on the website, and Edmund says he can access it. Yeah, I'm not surprised. And Eric says the same. I think that it's different internet service providers are do that. I'm not sure why. It's beyond my ability. How long do we have the access to the info? I don't think there's any limit on it. Do I sign up on the site for the login info, or was that emailed to me? I think you have to sign up on the site for it. But I think you have to sign up on the site. Somebody mentioned difficult to teach. I would add the topic on its own is a challenge, but real challenge is the coordination with the vertical line chart plus the Wyckoff concepts, a lot in one bite. Yeah, it is, and that's why, I mean, there are more advanced ideas on point and figure charting and stuff, but and kind of slab-sided stuff starts to fall into that, and that's why I only treated that lightly. I really didn't want to get into it because I felt like it was too much for people to digest in one shot. This is more than that. You don't need any more than this, believe me. And it's I mean, this is pretty comprehensive, especially with the count guide. It's pretty comprehensive. So okay, you prefer the old website, not us. We had problems with it. Okay, glad you guys all like it. And do me a favor, please, and do that evaluation when I send it to you. And I want to say thank you all very much for coming into this and spending your hard-earned money. I know it's not easy. And also the time. This is a lot of time to put in on this stuff. And it isn't easy, but the rewards are tremendous if you can get it down, because this stuff really does work. So I really appreciate everybody's, coming in and doing this and interest in the Wyckoff method. It's really nice to see. So thank you all, and good trading out there. Be mindful in your trading, of course, and use this stuff now. Study it hard and use this. And I'll see you in deep practice if you're in deep practice, or on some of the free things that we do, and this new thing, this chart, what's the right trade? Kind of participate in that. We'll have fun with that kind of stuff. All right, everybody, thanks a lot. Take care now, and bye-bye.